take it from here. They were going to talk about, well, the main thing about coronavirus, well, which is coronavirus. I've known Dan for years, and a few months ago we spoke about me visiting the Scandinavian capital markets offices in Stockholm. We had a trip planned in April, and of course was cancelled because of the virus, but here we are online, and everything is related in some way or another to the virus. So let me kick it off. Just a quick presentation about myself. I used to trade forex, day trading, and swing trading like Charlie presented before. Then I kicked off forex crunch back in 2008, another time of crisis, which looks minuscule in comparison to what we have now. And I focus more on fundamental analysis, so less on trading now, and that's what I'm going to talk about today. I joined FXStreet, one of the largest forex portals, back in 2018, and of course now we're all working from home here in Barcelona. And yeah, so just a bit about what I see as, in general, fundamental analysis is what the big picture for markets is, what moves markets, and technical analysis is great for finding entry and exit points, for the more practicalities, but identifying trends. Bigger picture, I see it in what's going on with the virus, interest rates, everything related. So we'll cover today the state of coronavirus, of course, as I see it, and things are moving fast and it's very hard. That's going to be my first disclaimer, and maybe I'm going to add a few more during the presentation. And then what's driving markets so far. Then, of course, we cannot skip talking about the second half of the year. The main political event is the US elections. I think since 2016, since the election of Trump and Brexit referendum, politics have taken a more significant role in comparison to the past, overriding economic figures in many cases. And yes, Brexit, it hasn't gone. Some people miss it because it's more interesting to talk about Brexit than a deadly disease. And I'm going to finish it off with more of the practical stuff, how markets have changed and what I see moving forward. And of course, have time for questions. So COVID-19, it's not going away anytime soon. Here's a chart which I like. There's so many charts in there. I think the Financial Times charts are among the best. So we see how the disease blew up in March and April. We all remember those darker days, and things have stabilized, at least here in the Western world. It is worsened in Latin America, of course, and India, but it's far from over. With removing of the lockdowns, we're seeing a rise in cases, especially in the United States. This is another good chart from the New York Times when looking at America. So we're seeing cases rise, and it's not only due to more testing, which is of course a good thing. More information, also when trading markets, more information is better, but also an increase in the hit rate. And that means that more tests come out positive, and hospitalizations. Houston, Texas is the most significant case. They're on the rise. All over the world. I'm originally from Israel and live here in Barcelona. We have the rally around the flag each time, in my unfortunate case in Israel, when the war breaks out, or in this case, disease spreads around the world. We have the rally around the flag effect. Everybody's staying at home, feeling we're doing it for our neighbors, we're doing it for the nation, for our families, and everybody's ready to take a hit. We're all in this together. But in poorer countries, have colleagues in South America, not working for a long time. There's not enough help from the government, and people need to eat, and that's when political division begins. Here in the Western world, fortunately, we don't have that kind of problem, but if a business was able to withstand the hardship of the lockdown for the first time, thinking, okay, I'll take this cheap loan from the government or from the municipality and I'll carry on, the second lockdown is already a blow to business confidence. It's also a blow to consumer confidence, of course, and we already have new well, ways of living our lives. So sure, we mentioned before going to the mountains to hike, but I also go to the gym from time to time. But now with the lockdown, I already have my sort of home gym, and I won't be going back to training back there. Same goes for all kinds of other activities. People changed their behavior, and with the second lockdown, the chances of returning back to normal life are falling. Of course, new economic activity always emerges, but these transitions take time, and of course, politics become uglier. Here I put a picture of Trump, which is of course the leader of the richest country in the world, but it happens also here in Spain, in my country, in Israel, in Sweden, I know, where Scandinavian is based, there are political divisions. So that's when the fractures also have their impact. There's a few positive developments about coronavirus. So I don't want to paint only a gloomy picture. Doctors everywhere have lots more experience. We learned that 2 existing drugs help. One of them is remdesivir, made by Gilead, which is relatively expensive, and dexamethasone, I hope I pronounced it correctly, according to research in Oxford University. Also, it reduces mortality rate. It's a serious research. And money is thrown at the vaccine. So eventually, we're all hopeful a vaccine will show up. The bad news is, as we know, it's highly contagious. Of course, we're talking in recent days about cases in US states where they didn't lock down as much as needed probably, and they opened up too quickly, but also in places that were exemplary in their response, such as Australia, where the previous speakers comes from. We're also seeing a resurgence in cases in Melbourne, so it's really hard to control. And an acceleration of a vaccine is a bit limited. Factories in India are preparing. A company in America, Inovio, has a contract with the Department of Defense to get ready for producing vaccines en masse once they're ready. But all this acceleration is a bit limited. And the ugly, there's a case, it's hard to see a herd immunization. Stockholm, according to official data from the end of April, hopefully things have changed since then, if I'm not mistaken, only 7.4% of people in capital city have the antibodies. Here in Spain, it's about 5.2%. So it'll take some time. And there's another research from Wuhan that shows that these antibodies, they eventually disappear. Now, that's we all are a bit skeptical about Chinese figures. That needs more peer review. That needs another serious study. But if antibodies don't hold up in the body, so yeah, again, I'm painting a gloomy picture that maybe a vaccine will never be seen. Hopefully this is wrong and something will show up. Humanity has been winning for thousands of years, so let's hope for the best. Coronavirus and timing, what we know so far, or let's say as far as I understand, of course I'm not a doctor, another disclaimer, closed spaces are more contagious than open ones. That doesn't mean that hot weather doesn't kill the virus, and cold weather doesn't help it move around. It's being in a closed or open space. I think that's one of the reasons we're seeing a rich country like the United States, where the weather is hot in the south, that is suffering now from an accelerated spread of the virus. So that's why I think that the summer, at least here in the northern hemisphere, could be more deadly, while the autumn, when windows are open and it's more comfortable to sit outside, that's when things may improve. And that, of course, has an impact on markets. We'll reach that later on. Now, let's move to the second topic. What's the biggest driver of markets? By far, It's this guy, Jerome H. Powell, chairman of the Federal Reserve.
Yohay,
yeah.
May I interrupt just for a second?
Sure.
I'm not sure if you are seeing what we are seeing, but every couple of seconds the screen seems to flash to another screen that you might maybe have open, and then it flashes back. It's almost like subliminal advertising. Don't know if there's something you can switch off.
Oh, okay. I changed. Sorry for that. I wasn't aware of it. Now it's
only a small irritation. If it was simple to fix, that might be better because it just keeps flashing.
Yeah. Sorry for that.
Again.
I put my screen on screen of monitor 2. Let me just, sorry for the inconvenience. Let me try to just show the relevant. Maybe that's. Sorry for the delay.
Not a problem at all. I thought it was just my eyes, but actually one or two other people had noticed it as well. So it's.
Sorry, let me just isolate.
I think they're both trying to broadcast through the same window or something like that. Something technical.
Okay. Now it should be the only thing on my screen, the presentation. Maybe that should help.
Wonderful. Thank you very much indeed.
Okay.
I appreciate that.
Sorry for that. I wasn't aware. Anyway, so we talked about what I see about the disease, and now let's talk about what I see as, well, the biggest driver of markets. That's the Federal Reserve. So this guy has been compared to Superman. That's a graphic presentation of what Fed Chair Jerome Powell and his colleagues have done. That's the Federal Reserve's balance sheet. Of course, from 2008, from the financial crisis, it has been growing. Then we had period of stability when things were improving. It stood around $4.5 trillion, dipped back below 4 trillion when things were improving. When the Fed began tapering down, then it stopped it, and now it's around just above 7 trillion. And these 3 trillion, more or less, what's a few billions of dollars between friends, that made the major difference. That's the graphic presentation, but of the current crisis. Let's take a look a bit to the past. The 2013 taper tantrum, when Ben Bernanke, if you remember him, Fed chair, began talking about tapering down quantitative easing. We had markets in a tantrum, falling, and in the more recent past, in December 2018, the Fed raised rates for the 4th time that year, and we had a crash just after Christmas. And last year, 2019, the Fed began undoing 3 out of these 4 rate cuts, and that triggered a rally, while stocks on Wall Street did not present higher earnings. And yeah, I want to thank my friend and colleague Lear Cohen for sharpening my mind on that specific point. So it's all about the Fed, apart from, well, its balance sheet grew thanks to more QE. Unlimited, the Fed is just buying lots of bonds, corporate bonds. To stabilize the financial system back in March, when there was real panic, the Fed then introduced swap lines with other central banks, so that basically providing dollars around the world. That helped, of course. Is buying bonds also, or open to buying bonds of what's called fallen angels. That's a very nice term to describe firms that have recently lost their investment grade status and now are in junk territory. And well, maybe one of the most puzzling moves they did recently was they announced this bazooka, which is never supposed to be used. A threat of something just being there should prevent investors from panicking. They talked about buying corporate bonds, and last week, 2 weeks ago, they announced they're beginning to use it. And I've been surprised so many times over the past few months, and who knows what else is in store. Something that I didn't put here in the presentation is negative interest rates. I think they've seen the experience from here, from the Eurozone and from Japan. doesn't really help the economy, so they won't do that. But the Fed is really supportive of markets, ready to respond. They call it financial conditions, and that's sort of a code word for keeping stock markets happy. And as somebody else this morning also mentioned, there is no alternative to buying stocks. There are other reasons stocks are on the rise. So real estate, commercial real estate, we had a discussion about in the office, if we're going to go, I mean, the virtual office, are we going to go back to the office? Maybe, who knows? People are going less to restaurants. Offices are struggling. Sure, Amazon and others need warehouse space, but in general, here in Spain, tourism is falling. So maybe investing in real estate is less attractive than it used to be. Bond yields are low. I mean, that's the Fed's achievement, of course, making long-term interest rates lower. So, and that's the only real change. If you look at a snapshot of markets now and before the pandemic, you see S&P 500 back to where it was, more or less. But yeah, bond yields are very low. So we're going to throw money at stocks. And it's not only the Fed. There are other factors. There are some companies that are really worth investing in. These famous FANG stocks, they're making money. Subscriptions to Netflix, deliveries from Amazon. I increased my buying quite a bit, and other tech companies. There is also a savings glut among remote workers. So people that work at home, and we are lucky to be able to do so. We're saving money during this time. So that, of course, this money has, again, no alternative, so it can go to stock markets. And there's no sports to gamble on. There's always a factor of gambling in trading stocks and trading markets. And when gamblers don't have sports, and here's a picture from Korean baseball, which was open before other, well, Premier League in the UK, for example, and with artificial fans, but it doesn't draw the same attraction as US sports, for example. So that also pushes people into stocks. And of course, the Robinhood revolution, if you wish. Robinhood, this application for trading stocks, made it much more accessible and cheaper. Other trading firms also lowered their fees. And now there's a new breed of stock traders which are gambling on stocks. We recently had the story about Hertz, the car rental company, and so many people piled into that after the company went bankrupt that the firm was even ready to issue new stock, saying it will be practically worthless, and there was still enough interest. Eventually it didn't go through, but of course that's the extreme example. But the buy the dip mentality is alive and kicking. All right, so now let's move on to the US elections. So going back to 2016, Trump won and stocks surged. I see it as a bit broader than that. I see it as not only that Trump won, a Republican president, but also that the Republicans gained full control of Congress. So it's not only Trump, in this case, against presumptive Democratic nominee Joe Biden, but of course, who wins power? The status quo is that Republicans hold on to the Senate, and here on the right we have Mitch McConnell, and that Democrats control the House, the same status quo. And that would be a split government, which I think will not move markets that much. And I think the real fear for markets is if the Democrats win the Senate. Let's talk about President Trump. He's always grabbing attention. Even without Trump, it's more about when there's a president running for second term, it's more about the incumbent than about the competition. As I see it, he was doing quite well actually until coronavirus. Despite, look, he was on course to win the Electoral College, even with losing the popular vote like we did in 2016. But then came this major crisis, and again, everything is related to coronavirus, and also his handling of Black Lives Matter. And well, the economy is not working very well, and the focus shifted from, well, is the economy doing that well, to leadership. And by the way, that it's the economy stupid slogan from the 1990s around Bill Clinton's victory. That's not always that true. Barack Obama won in 2012, despite not so great economy. So it's not only about the economy, I guess it's about leadership. And one topic that Trump would like to have in the elections, and he's been dealing with, China. China is quite a lot with the trade deal. I don't think unless he breaks the trade deal, then markets will move. Other topics are more important. A few weeks ago, we saw Peter Navarro, the president's White House advisor and the known China hawk. He wrote a book called Death by China. He said that trade deal is over, and markets then were in a state of shock, and then he had to walk that back. Trump also intervened to deny it. So as long as the trade deal holds, I think China, which may be a significant topic, I mean, for Trump, but I don't think it'll matter that much for markets. So we're seeing in recent polls that Trump is losing a bit of ground. Let's talk a bit about his rival, Joe Biden. So non-charismatic former vice president, quite old, older than Trump, closer to 80. He's seen by many people as a safe pair of hands. His better relations with the world. Here are pictures with former President George W. Bush and Angela Merkel. Reverting back to China for a second, I think Chinese manufacturing, jobs moving out of the US, China cheating on intellectual property. Trump had a point in addressing these topics, but what he missed out is would be better to gang the rest of the world, especially European allies, and then face China and not pick fights with everybody. So I think Biden's message would be make America normal again, boring again. But markets maybe are okay with Biden. He looks friendly, he looks decent. He's sort of middle of the road Democrat, but they would not be very happy with his friends. In recent years, the Democrats have shifted leftwards. It can be a reaction to the Tea Party, a reaction to Trump, reaction to the global warming, to issues with healthcare. Here we see Senator Bernie Sanders, who had a significant contribution in moving the party to the left, preaching for Medicare for all, something that would hurt pharma stocks. Alexandra Ocasio-Cortez of New York, preaching for the Green New Deal, and she's a representative, and Senator Elizabeth Warren, also prominent figure, which has been sort of seen as the enemy of Wall Street for financial regulation. So if Democrats win all levers of power, that would be seen, in my opinion, as a nightmare for markets, because these figures, left-leaning figures, would carry Biden's presidency, the country more to the left, unfriendly to markets. So these are my two scenarios that Biden wins, and he looks to be in the lead now, 9 points, including in swing states. There are fewer undecideds as well. It means that Biden's lead against Trump is more significant than what Hillary Clinton had in 2016, because late in the race in 2016, voters broke towards the undecided, broke toward Trump. So I think there's a good chance that things will remain more or less as the polls are showing, that Biden wins. And for me, the bigger question is unified government or not. And if Biden wins and Republicans hold the Senate, I think markets will be okay with that. But if Democrats win full control, that would be a nightmare scenario. Of course, 4 months to go, anything can happen. We can still see things shift around so many times, there's still a chance that Trump wins again with losing the popular vote, and we have a split Congress. Basically, the exact same status quo. In this case, markets will shrug that off, or, as I see at the moment, highly unlikely case that Trump wins like in 2016, that Republicans recapture the House, which again seems unlikely because Democrats have a significant lead in the what's called the generic ballot over Republicans. But anything can happen in politics. In that case, investors will think more about, okay, more tax cuts, fewer pages of regulation in America's books, and that would send markets higher. A lot depends, of course, on coronavirus, which has shaken up the race. Everything is related. Yeah, so here's what I talked about before. According to Real Clear Politics, the Senate is split 48-48 with 4 seats for toss-up. If there's a tie, then the vice president casts the tie-breaking vote. So if we have 50-50 in the Senate, it would be perhaps Biden's unknown at this moment a choice for vice president, and that would again scare markets. Biden is leading. That's from 538, 9.5 points. I think it dropped to 9.3 in recent days. Anyway, there's a clear lead there. Yeah, and Brexit, the other surprise of 2016. No, it's not over. The Brexit saga. This tiger meme shows that, well, we all miss Brexit. It's better to fight about trade regulations and customs border and all these things than about well, talking about a disease. Here is Prime Minister Boris Johnson, one of the leaders of the Leave campaign. This is a picture from when he was sick with coronavirus. Luckily, he has recovered, and UK is still struggling with the disease, of course. So just for those not following the saga that much, the UK is already out of the EU. It left on January 31st. There were celebrations in Parliament Square, but Britain remains in a transition period, which means not much has changed on the ground. As we speak, there are negotiations in Brussels, if I'm not mistaken, between this nice guy here on the left, Michel Barnier. Okay, I'm saying that sarcastically. He's always, well, not that nice. And the British counterpart, David Frost, talk about future relations. But today is the last day for the UK to have asked for delaying, for postponing, extending this transition period beyond the end of this year. It will not happen. It was a clear message from Boris Johnson, from everybody. So unless there is a deal, there are various kinds of trade deals. The UK could fall back to unfavorable World Trade Organization terms. It would also, of course, hurt Europe. Delay made sense with coronavirus around. It also, it's a perfect excuse. It's also the modus operandi of the European Union to kick the can down the road. We remember that from the financial, the debt crisis. But the Brexit ideology of we have to leave, Brexit is much stronger. Today, extension deadline is gone. And I see also the British government is having the Brexit ideologues and having also a good political reason for leaving without a deal. First of all, there's no cliff edge scenario anymore. I mean, there was a deal about the divorce from the EU, but not about future relations. So the cliff is not going to be that big. And if the UK leaves and there's economic damage, would it be that easy to separate economic damage from coronavirus from that of Brexit? Better have all the trouble in once. It's important to remember Boris Johnson was elected with a huge majority only 6 months ago, 6.5 months ago. The next elections, are only in late 2024. Better we bring all the bad news now and then rebuild the economy, do other stuff, and get reelected. There's so much time. So I see it. I think there is a high chance that the UK leaves without a trade deal. Again, it's not the cliff edge of no deal at all. It's just a no trade deal. And I think it's a bit underpriced by markets. It will happen at the end of the year if it happens. And especially if markets are already down because of coronavirus, because of the elections, I think it could exacerbate the trend. It could be a bit shrugged off if things, well, improve. And it's underpriced or not priced, not by the pound and also not by the euro. The relations are close between the continent and the UK. And the EU is united and the UK is divided. But it doesn't mean that the EU will not suffer, including a large economy like France. So I think pound and euro could struggle. Now let's talk about a bit more practicalities. How market reactions have changed and a bit what's next. Of course, coronavirus is a big blow to the economies, well, of all countries all over the world. We're seeing, let's talk a bit about mood swings in markets. So in good times, we're seeing how headlines about a vaccine, about a cure, talked about these before, how they push markets higher. You can see the sensitivity. These are the buy the dip times. It often feels like a reality show. A firm called Moderna in Massachusetts published a research, only a press release, sorry, with that it made progress with the vaccine with only 8 patients, but markets ignored the details and went and advanced. That's when we have good news. We have to, as traders, identify when markets are looking for good news, and these are opportunities when we have these announcements. Same goes for reopening ones when economies reopen. And in bad times, I think we're going to have more now. It's COVID-19 statistics, hospitalizations in Texas recently, Florida cases, lots announcements in California and New York, of course, where the media is and the financial world is centered. And it oftentimes feels like a sports match with scores. And again, with sports on hold, makes sense that these are the kind of reactions. And of course, reclosing orders, which we're seeing now in quite a few US states, in Leicester in the UK, and in other places, in Melbourne in Australia, and others. Another change that we're seeing in markets is that money printing is good for the currency. Okay, not for the US dollar, but for the euro and the pound. We've seen with announcements of QE that the euro and the pound advanced. The Eurozone and the UK are not Zimbabwe here. Debt monetization is not seen as a bad thing in these coronavirus times, but actually as a good way for governments to fund themselves and boost the economy. Down the road, everybody is accumulating debt. This might explode. We've seen that crisis in the not so distant past. But for now, more is more and less is a bore. We've seen positive reaction most lately from in the euro in reaction to the European Central Bank's addition of 600 billion euros to its QE program. So yeah. Another thing, we've seen the dollar rise and become a bit stronger as a safe haven. Now, in mid-March, in the Ides of March, if you wish, there was a cash crunch, risk of a financial crisis. Of course, the dollar is the king of cash. And since then, of course, things have improved. There's money is flowing around. We're seeing the disease more under control in the West, at least. But still, the dollar is most of the time the safe haven of choice. Used to play sort of second fiddle, third fiddle to others, but now it remains the safe haven of choice. In bad times, go to the US dollar. On the other hand, the yen is losing a bit its shine. It's not that safe. It seems more sensitive to trade wars, which seem so 2019. Of course, there can be exceptions, but it seems less sensitive. I mean, it attracts fewer funds when there's well, negative coronavirus headlines. So it loses to the dollar in the safe haven match. And it also has more competition in the money printing scene. And my guess, prediction, call is that the euro will make its way back to becoming a safe haven currency. We've seen that very briefly in 2015. Back then, we had the last round, that was the last round of the Greek crisis, perhaps not the last. And we've seen the euro fall, for example, just after the agreement deal with Greece was signed, and the euro rising when things became a bit more tense in relations between the EU and Greece. And we might be seeing that now with the ECB's money printing, with the PEPP, Pandemic Emergency Purchase Program, and we're seeing it. So we might see that the euro attracts funds in times of trouble. We're seeing the euro as being a bit more resilient than other currencies such as the pound, or of course commodity currencies. So this, around coronavirus, this is the ECB's balance sheet. It's been jumping as well. So it gives a fight to the yen, which has been the traditional carry trade funding currency. And so the euro, my call is that it could become more of a safe haven. Again, dollar is king. Gold prices are the highest since 2013, especially now ending this month with the blast, ending the second quarter with the blast, around 1770 last time I looked. And of course, the explanation that I hear is that money printing, and it makes sense, yeah, I don't deny it, but money printing by central banks, of course, we just talked about that now in the European Central Bank, the Bank of England, of course, the Fed, that's pushing prices higher. But I think it's more speculation. I think it's not the same kind of, I mean, maybe those gold bugs from 2011 might be back. I don't see a chance of hyperinflation. It's more speculation that, well, nothing else to invest in. Somebody else is buying gold. Maybe I should buy gold as well. I'll share with you something that Phil Carr from the Gold and Silver Club shared with me in an interview gave to me on FXStreet, that it has different behavior during the week, oftentimes suffers a bit early in the week and then rises later on. In general, its trend is a bit, yeah, it's a safe haven, but it takes 2 steps forward, 1 step back, and can be a bit more frustrating than, well, other these kind of stocks we talked about at the beginning. So let's talk about what's next. Now we're at the beginning of summer. So I think the current trends will continue. That means disease will continue spreading with air condition, and it's a bit out of control in some US states. Here in Europe, there's also a bit too much optimism. We might see hotspots. And I think also political trends will continue. That means that Trump continues being the underdog in the US elections. Biden, well, maybe enlarges the gap, and also maybe the Senate will become more and more in play for Democrats. So I think we could have optimism from the EU with their fund finally ending austerity, also from the UK and also from China. We've seen recent upbeat figures, but I don't think it'll be enough. I think the coronavirus with air condition is a bad combination, and we'll see the market suffering after a successful second quarter. I think the summer months will be a bit harder. Then entering the autumn, then I think with air condition a bit off, not too hot, not too cold, Goldilocks situation, perhaps not for gold, but Goldilocks situation for stock markets. A bit more optimism about the virus, perhaps also optimism that for investors that Democrats will not win the Senate, and we might see, usually September and October are bad months for markets. We might see things improving in September and October, but then in November and December, US elections will be messy. Just think about coronavirus and voting by mail, Trump says it could lead to fraud. Trump might refuse to go. It's in a very extreme scenario, but it could be just very close as well. So I think elections will be quite messy. It'll also take time to count all the ballots. I think November and December will be long months. And again, it's the Goldilocks situation in the weather in the Western world will disappear. It'll be cold again. People will be indoors more than beforehand. And I think we could get things worsening. To top it off, the Brexit impasse, and I would say call off the Santa rally. Here we have another picture I like to share always with Boris Johnson holding the bull, and I think it could also, he has lots of funny pictures. He could also have sort of a bit of a negative impact on Brexit, but I think everything is related to the virus. The virus is everything. I've heard people complain to news organizations, or we also had internal discussions about why can't we talk about something else? Well, there isn't that much going on. Even now, when things have improved, everything is sort of overwhelmed by coronavirus. Yeah, so that's the end of my presentation. I hope I didn't run that fast. Sorry for the technical stuff. I hope it has been resolved, and we have time for questions. Yeah.
You did sort that problem out for us. Thank you, Yohay. It's brilliant, and thank you so much for a wonderful recap on just exactly where we are. I mean, lots of problems, lots of issues this year. Lots of great comments coming in from everybody here in the webinar as well, on all sides of the political spectrum. But one thing you kept referring to is that yeah, the virus is underpinning everything. Everything is conditional on the virus, and yeah, quite sobering stuff. Listen to the Today program on BBC Radio 4 this morning, and they were discussing this outbreak of partying that the UK has seen in the recent weeks, people going to the beach and having street parties in London and so forth. And it's interesting that there is a psychology of so much bad news, so much risk that, well, you know, what can I do about it? I'll just go and enjoy that party anyway, because quite frankly, you know, there's risk, and I think particularly the younger generations, they feel themselves as immune to the virus. So there's all sorts of different issues colliding together in 2020. What a year! It's we're only halfway through.
Exactly.
So thank you for that. We have had lots of great questions, lots of commentary running along beside your talk, which was fantastic. One of the questions there relates to just the slide that you brought there, which is there is a concept that good traders do not follow the news. They look at the charts. So how does this relate, would you say, to presenting the bad and good news affecting the markets? In terms of traders, what should they pay attention to more, the news or the chart?
Yeah, well, as I mentioned at the outset, I'm more into the news. Now, the news is not only coronavirus news, it's also the response. And we had a slide of Superman, Jerome Powell, and that's what lifts markets, and that's what that's behind the movement in the charts. In the price action, if you look at the announcements, especially on Sunday, March 15th, a date I remember, and on April 9th were big announcements of more QE, and first one was also with the rate cut. These are the game changers that move the chart. So I focus on these announcements. Again, they can be good for markets or bad for markets, and they for me are what move markets. Yeah.
Fantastic. I'm trying to sift through the questions. A lot of us commentating on the virus, as we all do nowadays, and a lot of us commentating on Brexit. One or two suggestions that the Brexit deal might still be pulled out of the hat at the last minute. Richard saying, isn't there a standstill situation after the 31st of December when possibly a last-minute agreement can be pulled out of the hat? I don't know if you.
Yeah,
have it.
Yeah, I don't. That can happen. Deadline sharpens minds, concentrates minds. Expression goes. So sure, that could happen. We've seen how Boris Johnson and the EU crunched a new deal in October, the divorce deal. Can get into details of that, but sure, that can happen. My guess is that there will not be a deal, and that could be, of course, negative for the pound and the euro. And one of my considerations is coronavirus. That and seeing that Boris Johnson and his colleagues are serious about ideology of being more detached from the EU and less aligned. So I do take them at their word, and I think bringing all the bad news for the economy together, there is a risk again also for the EU, also for the eurozone. I think they will go for that direction rather than agree to what Brussels demands, which is a realignment of regulations. And they say, well, Brexit was for getting rid of these regulations. So I think that coronavirus more presents an opportunity for them rather than something that will push them into compromise.
Well, it's true. From our side, we're very much seeing how the virus is being dealt with differently in the well, the United Kingdom is actually the disunited kingdom because the four parts, Northern Ireland, Wales, Scotland and England, all very much treating lockdown restrictions and rules differently. And I think it's the impact, it's an opportunity to flex their devolved political muscle here, and that's always worrying when politics is driving a health crisis. So we'll see how it all works out. And of course, in the context of Brexit, again, we might just go on for another few years yet. Marguerite says the problem with the present vaccines produces two kinds of antibodies, one increases the others. Yeah, I'm wary of us stepping too far into a chat about the virus on this presentation, but good point, Marguerite. It just clearly there's so much confusion and uncertainty there that is impacting the markets. So
yeah,
so I guess
for me it's not. Sorry.
No, you carry on, please.
Yeah, I also am unable, first of all, get into too many medical details, but as far as I understand, at least for now, and again, things change all the time, it's relatively safe to assume, let's put it this way, that a vaccine will take a very long time. So that's my take from all the news.
Yohay, I wanted to ask you about your outlook for the US dollar for the rest of the year.
Well, it goes hand in hand with markets. I was focusing on markets, but it's just the opposite.
And risk appetite, right?
Yeah, so I think we'll see a bit of risk aversion in the summer, in July, August, and then risk, which is positive for the dollar, and then risk aversion, risk appetite in September and October, which is negative for the dollar, and then again the seesaw will swing in favor of the dollar towards the end of the year.
Interesting. Okay.
A few more questions.
Yeah, just looking through questions again here. Richard just said targeted approach to lockdown is far better for people. Yes, Richard, I agree with that. And you know, from an economic point of view, although it's unfortunate for obviously Leicester's the first city going into lockdown. Not sure quite how they're going to ring fence sport, and I think we'll see a lot of people nipping down the road at the weekend to the pubs in the nearest neighbouring towns and cities. But hey, you know, we have to try something, I guess, to contain it. Steve saying, oh, the Forex Crunch website, maybe there's an issue with that. Steve saying he's not able to get into it at the moment, so
yeah, there is an issue with that. Unfortunately, on the day that I'm presenting and putting the link to the website here on the yeah, it should be resolved in the next few hours. I've been notified.
Oh, listen, I've been looking at the website myself for the past few days. It's fantastic. There's a lot of great content there. So when that temporary technical issues resolved, get into forexcrunch.com. It's a great source of where Yohai's putting a lot of his commentary and blogs, which is great. I think, Yohay, we should say thank you. We've enjoyed a fabulous presentation. It's a lot more than I was expecting, so I'm really grateful for you coming along and joining us.
So thank you, Simon, and Dan, of course, and Scandinavian, and Smart Bootcamp, and come visit ForexCrunch when it's up again, and FXStreet, and thank you very much again.